Hello and welcome. This is the financial management course, and my name is Krishnamurthy Bindumadhavan. Today, we are going to continue the discussion on foundations of financial management, part 3, and we are going to focus on the income statement. We have already looked at the balance sheet, and if we step back, as you will recollect, we are currently exploring the key financial statements. And there are three important financial statements: the balance sheet, the income statement, and the statement of cash flows. We've already looked at the balance sheet. We are now going to look at the income statement. So, first of all, what is the income statement? Hopefully, it is not completely new to you. And I think that would be for two reasons. One is probably you have had some exposure either in your organization professionally, or maybe just looking at the internet. Maybe you are interested in the share market. So personally, you might have also got some exposure, or professionally, you might have got some exposure. But more importantly, I think through the accounting course, that is the financial and management accounting course, you should have got some exposure to the income statement. But anyway, we will go through the income statement and try to understand what exactly it is trying to tell us, what information is there in the income statement, because our motive here, as I have told before, is very different from the accountant. The accountant's objective is to actually create the income statement potentially by looking at the books of accounts and then trying to tally up what are the revenues, what are the expenses, then what is the profit. So he is trying to create it. Our goal is not to create the financial statements, any of them for that matter, but our goal is to interpret the financial statements. So, income statement essentially at the crux of it is nothing but a statement which tells us in the last operating cycle, in the period of interest to us, which is usually 1 year, what were the revenue, what was the revenue of the company, what were the expenses of the company. And so if you subtract these expenses from the revenue, then what you have are the profits. So that is essentially what it is trying to tell us. This is called the top line. The revenue is called the top line and the profit is called the bottom line. That is how we refer to it in finance. And if you see the TV, for example, if you look at news shows like CNBC and so on, where they host financial analysts, talking about different companies, how the company is performing, etc., they will refer to top line, bottom line. That's what they're talking about. Top line means the revenues, bottom line means the profits. So the income statement essentially tells us what are the results of the company's operations over a certain period of time. And that period of time is usually referred to as the operating cycle. And the operating cycle is typically 1 year. And in India, the operating cycle or the financial year goes usually from April 1 for a particular year, XXXX, to March 31st, XXX, and then the next year, so X plus 1, right, so to speak. So that is usually how the financial year is stated. But it varies from country to country. And for some companies, even in India, they may follow a slightly different sort of a period. But, mostly it will be either January 1st to December 31st or April 1st to March 31st. There are also some companies in the United States which follow July 1st to June 30th. These are sort of the three things, three time periods which are commonly prevalent across the world. And again, there could be some variations depending on the country, etc. I am not very familiar with Latin America, for example, or in some of the mainland Europe, I'm not familiar. So it could be different there. But generally, in India, for sure, most companies will follow this kind of a reporting timeline, April 1st to March 31st. And you are all, I'm sure, familiar with that. So it tells us what were the revenues of that company in that particular period. Right? What are the revenues? What are the expenses? And if we subtract the expenses from the revenue, then we have the profit number. So that's what we are saying. What goods were sold or services provided, which gave the revenue for the company, right? If we are talking about a company like, for example, Dr. Reddy's Laboratories, or if you are talking about some other company, a manufacturing company, essentially it is the goods sold that will generate the revenue. But if it is a services company, let's say it is Infosys, for example, then the services that the company performs, which could be consultancy services, those will provide the revenue for the company. So it could be either goods sold or services performed, which generate the revenue for the company. What costs were incurred? Now that's the expenses side. So that's where we are talking about the expenses. What costs were incurred in the normal operations to generate those revenues? When we are talking about a manufacturing company, there is a cost of goods sold which will play a role. There could be other costs also. For example, general administrative expenses, marketing expenses, right? Various expenses are there. I have broadly put it as expenses. We will take a look at one of the financial statements. We'll look at Dr. Reddy's Laboratories, the latest financial statement, the income statement. We've been doing that, right? We've looked at the balance sheet of Dr. Reddy's Laboratories. Today, we will look at the income statement of Dr. Reddy's Laboratories so that you get a perspective of how an actual income statement looks like. Right. Another name for the income statement is the profit and loss statement. So we can use that interchangeably. So we may either refer to it as the income statement or the profit and loss statement. Okay. So what expenses or costs were incurred is the second thing that will be reflected in the income statement. And clearly, revenue minus expenses is what we define as the profits. So what are the earnings or the profits of the company? That is the bottom line that we can get out of the income statement. So a very important statement indeed, because it tells us about the profitability of a company's operations. Right. And that's important because if the company is not profitable, then it cannot sustain itself in the long run. I mean, so a company that is not profitable cannot sustain itself in the long run. Temporarily, if the company is suffering losses because the environment is not good, let's say, as I've told you before, the business cycle is usually up and down like this. So there could be a phase when there is a sort of a downward trend in the economy, when the economy is not doing well. That is what we call as a recession, or a bust, or a recession. So when there is a recession, then yes, I mean, the company may not do well, but it will have to hunker down, it may have to cut costs and try to manage, somehow get through that period of difficulty, and then it should be able to recover and get through. And then it should be able to recover and get through. So that's the idea, right? So basically, company which is not generating profits on a consistent basis cannot sustain itself, cannot survive. And that's what happens. I mean, there are a number of companies which have failed over the years and for various reasons, but mainly it is because they are not able to run their operations effectively. Right. So running the business operations is indeed very in an effective manner, in an efficient manner, is very much necessary for sustainability of the company and for the growth of the company. And the income statement provides us with clues and information as to how the management of the company is doing in terms of running the operations of the company. So very, very important statement. Now, just a quick contrast. I have already mentioned the difference between the income statement and the balance sheet. So the balance sheet is a snapshot in time. It is at a particular period in time. 31st of December, that would be the US typically. 31st of March, for example, would be India, right? And then the starting would be right before that. So, I mean, it starts and then it ends, right? So, right after that, we can say. So, from here, April 1st of a previous year, right? Some year, let's say 2012 to 31st March 2013 would make 1 year, right? So the balance sheet is at one point in time. It tells us the financial picture. What are the assets of the company? What are the liabilities of the company? And assets minus liabilities is equal to the equity. Or another way to state that is that liabilities plus equity is equal to assets. We have said that that is called as the balance sheet entity. That is the basic balance sheet equation. We have looked at that. So that picture is a snapshot in time. That means at one point in time, we are able to get that information. But the income statement is a flow statement. It is from 1st of April to 31st of March, or 1st of January to 31st of December, 1st of July to 31st of June, something like that. So the income statement is a flow statement which tells us what were the revenues of the company, what were the expenses, and therefore the revenues minus expenses gives us the profits or the profitability of the company during that operating cycle. So that is how the income statement is set up. So it's a flow statement, whereas the balance sheet is a snapshot in time. This is what I have talked about. What are the revenues? The revenues are essentially created through business operations, right? So when you run your business operations, you maybe manufacture something. Let's say Dr. Reddy's Laboratories, they are manufacturing bulk drugs. So when they manufacture those bulk drugs, then they may sell it to maybe India. In India, they may be selling it. They may sell it to the United States. They may sell it to European customers, and so on. So as they make these sales, they will generate revenues. Those revenues could be either in cash or it could be in the form of a credit. If you sell your product on credit, that is, you are going to sell, let's say Dr. Reddy's is selling, I don't know, let's come up with some number, $10 million worth of some drug to a European company. Then companies will typically not be able to pay the $10 million in cash in one go. So what they will say, and this is called the terms of the trade, or trade terms, right? So so typically it will be about 1 month credit, or maybe sometimes 45 days credit, sometimes 2 months credit, sometimes 3 months credit, things like that. So when you sell it on credit, that is called as accounts receivable, and that will sit on the balance sheet because that is money that is coming to us. And then when the company actually pays, then it will be transferred to cash. So essentially, revenues will be generated by the company, either cash revenues or accounts receivable, right, in the form of accounts receivable. So that's one important thing. And then the expenses, which could be either cash expenses or accounts payable, for example. That means when you are purchasing something from your suppliers, for example, let's take Dr. Reddy's Laboratories. For the bulk drugs, to manufacture these bulk drugs, it will require some chemicals. I'm not very familiar with this particular pharmaceutical industry that much, but I have some sense. So for example, it might require certain chemicals that may go into the manufacture of these bulk drugs, right? These are all drugs, these are all chemical manufactured drugs as compared to antibiotics. Antibiotics are essentially fermentation is going on, and then you produce these live sort of antibodies which then can help us to fight infection. That is one type of drug. The other are bulk drugs, which are usually chemically created compounds. Could be artificial compounds, could be natural compounds, and so on, which are identified through a systematic and scientific testing methodology, and to identify which one will work against a particular disease. For example, scientists are constantly working to try and identify molecules which can cure or at least minimize the diabetes, for example, right? Blood pressure, right? These are all lifestyle diseases, as they are called, and there's a constant battle going on trying to develop better products to try and cure, if not cure, at least to minimize the impact of these diseases. So for that, there are chemicals that are necessary, and so that would be the input. Now, Dr. Reddy's probably buys these chemicals from various suppliers, and it might be buying them in crores of rupees. And so Dr. Reddy's will have some agreement with those companies as to how it will make those payments. And typically, the way the corporate finance function works is that they will have a setup wherein they will make monthly payments or maybe quarterly payments, and they will try to synchronize these payments along with the incoming payments from their customers. So their outgoing payments are to the suppliers, incoming payments come from their customers. So they will try to synchronize it so that there are no gaps, there are no funding gaps, right? So that is one approach that is taken as part of working capital management. We will discuss this little later in the course, but that is one common strategy that companies follow so that they don't have funding gaps, unnecessary funding gaps wherever possible. So they could either purchase it on cash. Sometimes they may have to purchase some things on cash, right? I mean, if you're going to buy a box of pencils, if you're going to buy some notebooks, then you can't say, give me 1 month credit. That shopkeeper is not going to give you credit, right? So for certain petty things and small things, they may buy on cash, especially a big company. And then for the other things, like if they're going to buy chemicals, let's say worth 10 crores, then that will usually be on credit. The suppliers will rush to give credit to a company like Dr. Reddy's, and so they will buy it, and then it will be an IOU, right? It will be a piece of paper which will say, I owe you money, I owe you rupees 10 crores, and then the due date will be there, maybe 3 months from now, or 3 months seems a little bit large. Usually it might be 30 days, to 60 days. Okay, 3 months is a bit on the higher side, but generally 30 days, 45 days are common. So that will become an accounts payable on the balance sheet, and then when the actual payment is being made, then it will cancel out, and then the payment will be made out by the company from cash typically, right? So that's, so either it could be a cash expense or it could be an expense which is on credit, I mean a purchase which is on credit, but nonetheless it's an expense for the company. Okay, so the actual cash payment and the expense are two different things. That is the point I'm trying to make here. So please note that. So whether it is a purchase that we are doing or whether it is a sale that we are doing, irrespective of whether it is cash on cash, whether we are making the sale for cash or whether we are making the sale on credit, and whether we are making the purchase on cash or whether we are making the payment on credit, right? It doesn't matter. It doesn't matter as long as we are able to say that we have completed the process, the manufacturing process, then we will recognize that as a revenue and we will recognize all the operating costs associated with that as an expense. So that's the distinction that we have to understand. That's how the accrual accounting works, which is the sort of the benchmark or the cornerstone of the entire accounting system in the developed world today. Okay, so nobody does cash accounting, maybe in a few countries in Africa, sorry for saying Africa, but in some maybe less developed countries, they may be using cash accounting. But in most of the developed world, and including India, for example, or any major country in Asia, they all use the methodology referred to as accrual accounting. And one of the principles in accrual accounting is the matching principle, wherein we say that the expenses and revenues have to be matched. And when the revenue, when the revenue, so when we are selling, suppose you are manufacturing 1 ton of bulk drugs, whatever the inputs that went into that 1 ton of bulk drugs will be captured. So suppose in this period, let us say in the current period, we are now in November, so let's say in the last period from 1st of October to 31st of October, let's say 10 tons of some bulk drug was manufactured by Dr. Reddy's laboratories. Then whatever the inputs that went into it, into that manufacture of the 10 tons of the output, this is the output. So whatever that went in, those would be the expenses. And then if you are able to sell this, let's say they have sold this much in this month, then that would be the revenue. So revenue and expenses will have to be matched. And so revenue minus expenses will give us our net income or profit. Okay, so another name for net income is profit. So this is how the income statement works. Okay, so here's a sample income statement, but better still, I will take you to Dr. Reddy's laboratories right now, to their website, and then we will take a look at the income statement, the latest income statement of we'll take a look at the latest income statement of Dr. Reddy's laboratories. So here we go. So I am already at that page, so I have got it set up for you. So this is the statement of profit and loss. As I said, we can refer to it as the profit and loss statement, or we can refer to it as the income statement. It's one and same thing. And so you can see how they have listed the income statement. This is for the year ended 31st March 2014. This is the latest statement that I could find on their website. It's for our illustration purposes. So 2014, 31st March 2014 is this first column, and then the second column here is 31st March 2013. Right, so it is sort of a comparative kind of a statement that they have, and they are stating the income. So this is the revenue, another name. So when they say income, they are talking about the revenue. So you can see that total revenue they have put below, right? So they start with gross sales, then they subtract. Suppose there are any returns, we have to subtract that. Or if there's excise duty, in this case there's excise duty which you have to pay to the government. So therefore they subtract the excise duty, and then you get net sales. Then there are other things that they are generating, other sources, other ways that they are generating revenue, like for example license fees. So if they have developed some patented drug which then they license to another company for manufacture, then they may get some license fees. So those are listed here as license fees. Other operating revenue, and then revenue from operations they have listed. Revenue from operations, you can see, was 97,280 in the most recent period that we have from the from their website. That is the year ending 31st March 2014. Then there is other income. Other income is other than their normal operations. So they could have invested some money in maybe another company, right? They could have purchased another company, they could have invested in another company, they might have bank deposits. So income earned from those, that is other than the normal operations, we call that as other income. And it could also be sales. So for example, they might have had some chemical reactors which probably have become old. Let's say they purchased a reactor in 1995, now it is 2015, so it's 20 years old, the useful life of the reactor is over, they are going to sell it. So so those kinds of things. So certain things, again, that may be under operations because that's an operating item. But if they're selling things which are unusual, if they are having income from investment opportunities, things like that, those will all come under other income. And then the total revenue, which is 98,795 as per this financial statement for Dr. Reddy's Laboratories. This is a standalone statement that I'm looking at. It is only for the main company. They may have other subsidiaries, they may have purchased some other company, they may have interest in other companies. Those are listed separately. Okay, and then they will also have a consolidated statement for the group. So I am looking right now at the standalone statement of Dr. Reddy's Laboratories. I encourage you to take a look, right? That's what you should do. It's not it's something that you should I encourage you to take the time and take a look at the standalone statement more closely after the class. Also take a look at the consolidated statement of Dr. Reddy's Laboratories and see what is the difference between the two, right? Try to identify what's going on there. That's what I would encourage you to do. So that's the revenue side, and then below we have the expenses. So all the costs incurred in that period, right? What were the costs incurred that generated the 97,280 rupees? These are in millions of rupees, by the way. So 97,280 million rupees of revenue was generated by Dr. Reddy's Laboratories in the period 1st April 2013 to 31st March 2014, right? What were the expenses that the company incurred, right? What were the costs that the company incurred? So that is what is listed below, right? Cost of the material consumed, that's the first line. Then purchase of stock in trade and things like that. So they have got a number of things that they have listed here, and then the total expenses, which comes out to 74,251 million rupees. And so if you subtract the expenses of 74,251 from the revenue of 98,795, then we have the profit before exceptional and extraordinary items and tax, and so that is 24,544. Then if there are any exceptional items, like if they are going to hive off some unit, they are going to sell something. Sometimes companies do that. They will periodically take stock and say, oh, this is not core to our business, right? So they may say, we are, for example, Cadbury's has gone through or is going through a restructuring right now. You may have seen that, you may have read that in the newspaper. So Cadbury's, for example, were in many different businesses, but now the senior management has said, we will focus on chocolates, that is the confectionery items. We'll focus on X, that is chocolates. We'll focus on Y, we'll focus on Z, but we won't do some other things. Maybe, health drinks and things like that, which they were doing. We don't want to do that. So they have sold those. So they have sold certain businesses in the last 1 or 2 years. You can do a Google search and see. It might not be health drinks. I don't recollect exactly what units they sold, but some units which the senior management decided were not core to the business operations were sold. So if you do that, those will be listed under exceptional items, because that is not what you do every day, right? So every day what you do, that is called the business operations. What you don't do every day, like selling off a unit because it is not core, things like that, that would come under the exceptional items or extraordinary items. Extraordinary, exceptional, there are some accounting classifications there. Accordingly, they will put them in exceptional and extraordinary. We won't go into those minute details. That is not within our scope. As I told you, even in a basic accounting course, that would not be in scope. In an advanced accounting course, then we will look at those kinds of things, because that's very important for the accountant, so that they don't mix up. But for us, once they have done it and the auditor has signed that it has been done correctly, then we will take that and we will interpret that. That's our role. Okay, so then we subtract any exceptional and extraordinary items, and then we have profit before tax, and then there's a tax expense. We have to pay taxes. So there is the current tax expense, and then there's the deferred tax expense, which I explained to you before. The deferred tax has to do with the fact that they are actually showing potentially a lower income for tax purposes. This is for the financial statement for the investor, but for tax purposes, they will show a lower profit by showing higher expenses, like a higher depreciation expense. And so therefore that tax will hit them later on. I have explained this in a previous session, so I won't go into that details. So just you can so that reconciliation item is what is coming here, the deferred tax expense, and then profit for the year they have put, and then earnings per share and things like that. So this is how the profit and loss statement looks. Okay, and you can see that they have got the statement, comparative statement for the previous year also listed over here. They also have in another place a comparison, a 5-year comparison of the highlights. So that is also there. That's also worth looking at. Okay, so you can take a look at that also at some point in time. Let me see if I can go there. So I'll go there and show you. So yeah, this is the 5 years at a glance. So you can take a look at this also. So this is showing the last 5 years performance from 2010, 11, 12, 13, 14, right? So it gives you a picture. What are the revenues? What are the expenses? What is the gross profit? Then gross profit as percentage of revenues, then the operating expenses, then total operating expenses. This is, you see, slightly presented slightly differently from that profit and loss statement, but the numbers should match. But I think this might be for the consolidated company, that was for the standalone company. So slight differences in presentation, but essentially revenue minus expenses gives us profits. Okay, so that's what the income statement projects, and this is a comparison over 5 years. Okay, so now let's go back to the classroom. So this is another example. I won't spend too much time on it because we have looked at a live example of Dr. Reddy's Laboratories. You can take a look at it later. But suffice it to say that basically what we are doing here is we are simply taking the revenues, as I have mentioned before, right? We take revenues and we subtract the expenses from, we take revenues, we subtract expenses, then we get profit. Okay, so that's essentially what the income statement is all about. This is another way to represent it. You can take a look later. And in addition to Dr. Reddy's Laboratories, I would encourage you, because this is our work integrated learning program, so you have to see how you can integrate it with your actual workplace. And one way that I encourage you to do is to download the financial statements of the company that you are working for. Right? If you go to the website of your company, then go to the investor relations page, then you will be able to find the financial statements of your company, assuming it's a public limited company. If it's a private limited company, then you may be able to get that by talking to your finance manager or your, maybe your CFO or somebody like the vice president of finance or something like that. You should be able to get a copy of that. Take a look at it, right? Try to understand, try to connect what we have discussed in the class. Okay, so that will help you to improve and enhance your understanding, right? And integrate it with your actual work. Okay, maybe you're not doing that, right? Your work may not be to either build the statement, that would be the accountant's work, or to analyze the statement, that would be the financial analyst's work. Maybe you're not doing that, but that's okay. You need to understand. Why? Because in today's world, unless you understand and interpret the financial statements effectively, you will not be able to progress in your career. This is something I have mentioned before as well. So I encourage you to try and learn that, so that you can effectively interact, you can learn the language of finance, so that you can communicate with your financial analyst, your senior financial managers, your business leaders, for example, in a more effective manner. And right now we are only laying the foundation. We are trying to understand these statements, but later in a subsequent class, we will see how to use this information, how to do, for example, financial statements analysis, that is looking at ratios. How can we interpret how the company is doing by looking at various important ratios? So this is another way to state the income statement. Look at your company's income statement. Look at Dr. Reddy's Laboratories, which I showed you, right, which I shared with you. Look at some other top companies in your industry. Maybe if you are working in the automobile industry, look at Tata Motors. If you are working in the pharmaceutical industry, I think Dr. Reddy's is a good example, but you can look at other companies as well, similar to that, right? Cipla is there. Many other companies are there, which are leaders in the pharmaceutical segment. If you are in the chemical industry, look at Tata Chemicals, look at Reliance Chemicals, Petrochemicals, things like that. So try to look at these various, download this information from the websites for public limited limited companies, and private limited it will be difficult to get that. So that you have to, that's a limitation. But public limited, there are a lot of different companies, so it should not be too difficult to source a few for your industry and then try to analyze it. If you have questions, you can always email me, right? Now, lastly, before we finish this segment, let me talk briefly about the statement of retained earnings. This statement essentially tells us, so what we looked at so far is the income statement. Before that, of course, we looked at the balance sheet. So the income statement says revenue minus expenses. Revenue is supposed to be plural, whereas expense is a singular, so we usually say expenses. Revenue is supposed to be a plural term, so we don't usually write revenues. So revenue minus expenses gives us our profit, and that sometimes we say profits or profit, it doesn't matter. So now from this profit, some of this will go to the investors as dividends. This is again something we have discussed before, and then the rest will be retained by the company, right? So this is referred to as retained earnings. I mean, this here profit that I'm talking about is the net profit after all expenses, including taxes. Okay. So now dividends are rewards to the shareholders because they have put their risk capital, they have given the money for as an equity capital, stock investment, whatever you want to call it. So therefore, that's a risk capital. So we have to reward them. And one way to reward them is through dividends. The other way, which I have also mentioned before, is to invest the money back in the company and grow the company so that the company becomes more and more valuable and the stock price will go up. That's another way to reward shareholders. And so that's what we are talking about here. This retained earnings is money that the company, the profits that the company is retaining so that it can fuel the growth of the company. If there are more opportunities, if the company is faced with a number of different investment opportunities, that would depend on the industry that they are working in, the competition level in that industry, the type of product that they are manufacturing, the culture of the company. Is it an innovative company like Apple? Then it's constantly going to develop new products, right? Or if you're in an industry like the biotechnology industry, electronics industry, IT industry, they are constantly changing, developing, very dynamic. So therefore, there is a need to retain the earnings so that we can continue to grow the company. So that's this statement here lists the retained earnings. What is the status of that? So we start with beginning retained earnings, then we add net income, right? So that's the total profit. Then we subtract what money goes out, right? And what is left then is the ending retained earnings. Very simple. All we are saying is we had some retained earnings as of last year. Now the entire profit we are adding to that. But then wait a minute, we don't retain everything. So we have to subtract the dividends that we pay. And then what is left is the ending retained earnings. So that's the statement of retained earnings. It's a sub-statement. It is not a very important statement. Just you should be aware of it. We won't spend too much time. We will probably never see this again in this course. But just for your awareness, I wanted to bring it up. So in this section, we have discussed about the income statement, which is a very important statement because it tells us about the profitability of the company. And then we took a look at the statement of retained earnings, which is not a very important statement, but still a supplemental statement. Thank you very much, and I will catch you in the next session. Bye for now.